Dear students, this lecture is for 5th sem students and the subject is accounting for managerial decision. Today's topic is inflation accounting and subtopic is International Financial Reporting Standard, Unit 5, Session 49. Students, the learning objective of this session is to know the importance of implementation of IFRS in India. And at the same time, the session outcome is students will be able to know that accounting standards provide a framework and accounting policies so that financial statement of different enterprises become comparable. In order to provide transparency, consistency, comparability, adequacy and reliability of financial reporting, it is essential to standardize the accounting principles and policies. Accounting standards provide framework and standard accounting policies so that financial statement of different enterprises become comparable. Let us try to understand the meaning of accounting standard. An accounting standard may be regarded as a sort of law, a guide to action, a settled ground or basis of conduct or practice of accounting. Let us focus on meaning of IFRS. IFRS are a set of international accounting standards and covers full set of principles and rules on reporting of various transactions in financial statements and also states how particular types of transactions and other events should be reported in the financial statements. They are the guidelines and rules set by the International Accounting Standard Board which the company and organization can follow while preparing their financial statement. Let us focus on the list of international financial reporting standards one by one. IFRS 1, that is first time adoption of international financial reporting standards. IFRS 1 requires an entity that is adopting IFRS standards for the first time to prepare a complete set of financial statements covering its first IFRS reporting period and the preceding year. IFRS 2, that is share based payments. IFRS 2 specifies the financial reporting by an entity when it undertakes a share based payment transaction including issue of share options. IFRS 3, that is business combinations. The core principles in IFRS 3 are that an acquirer discloses information that enables users to evaluate the nature and financial effects of the acquisition. IFRS 4, that is insurance contracts. IFRS 4 applies to all insurance contracts including reinsurance contract that an entity issues and to reinsurance contracts that it holds except for specified contracts covered by other standards. IFRS 5, that is non-current assets held for sale and discontinued operations. IFRS 5 requires a non-current asset or disposal group to be classified as held for sale if its carrying amount will be recovered principally through a sale transaction instead of through continued use. IFRS 6, that is exploration for and evaluation of mineral resources. IFRS 6 specifies some aspects of financial reporting for cost incurred for exploration for and evaluation of mineral resources, as well as the cost of determination of technical feasibility and commercial viability of extracting the mineral resources. IFRS 7, that is financial instruments disclosures. The IFRS 7 requires entities to provide disclosures in their financial statements that enables user to evaluate the significance of financial instruments for the entity's financial position and performance. IFRS operating segments. IFRS 8, it specifies how an entity should report information about its operating segments in annual financial statement and in interim financial reports. It also sets out requirements for related disclosures about products and services, geographical areas, and major customers. IFRS 9, that is financial instruments. IFRS 9 specifies how an entity should classify and measure financial assets, financial liabilities, and some contracts to buy or sell non-financial items. IFRS 10, that is consolidated financial statements. IFRS 10 establishes principles for the presenting and preparing consolidated financial statements when an entity controls one or more other entities. IFRS 11, that is joint arrangement. IFRS 11 establishes principles for financial reporting by entities that have an interest in arrangements that are controlled jointly. IFRS 12, that is disclosures of interest in other entities. IFRS 12 requires an entity to disclose information that enables users of its financial statements to evaluate the nature of and the risk associated with its interest in a subsidiary, a joint arrangement, an associate, or an unconsolidated structured entity. IFRS 13, that is fair value measurement. IFRS 13 defines fair value, sets out a framework for measuring fair value, and requires disclosures about fair value measurements. IFRS 14, that is regulatory deferral accounts. IFRS 14 prescribes special accounting for the effects of rate regulation. Rate regulation is a legal framework for establishing the prices that a public utility or similar entity can charge to customers for regulated goods or services. IFRS 15, that is revenues from contracts with customers. IFRS 15 establishes the principle that an entity applies when reporting information about the nature, amount, timing, and uncertainty of revenue and cash flows from a contract with a customer. IFRS 16, that is lease. The objective of IFRS 16 is to report information that faithfully represent lease transaction and provides a basis for users of financial statement to access the amount, timing, and uncertainty of cash flows arising from leases. IFRS 17, that is insurance contract. The key principles in IFRS 17 are that an entity identifies as insurance contract those contracts under which the entity accepts significant insurance risk from other party by agreeing to compensate the policyholder if a specified uncertain future event adversely affects the policyholders. Thank you.